traders, Gavin McMaster here from Options Trading IQ. And as you probably know, covered calls are one of the best strategies for generating extra income from options and from the stocks that you own. They're probably one of the more easy strategies to understand as well. I've been trading options for over 21 years. I worked in the hedge fund industry for over a decade, and they're still one of my favorite strategies. They're simple, they're effective, and they're brilliant at generating extra premium. But today we're going to be looking at whether it's better to trade short-term covered calls or medium-term or long-term covered calls. So do we look at the weeklies? Do we look at the 30 DTE? Or do we go 90 to 100 DTE? So short-term options are obviously going to give us the highest amount of return. But for me, it's not so much about the return, it's about how much work they are. Weekly options are not hard work, but they take a lot of management. You've got to be constantly rolling your trades every week, putting on new positions. Monthly, 30 to 45 days is probably a pretty good sweet spot. And some people will even go longer term. Like I'm pretty consistently in that 90 to 120 day range. I just find they're a lot easier to manage. They're very slow moving. So today we're going to have a good look at that. We'll look at the different returns based on different expiration dates, and we'll see how they all compare. So let's get stuck into it. Just a quick reminder that everything discussed is for educational purposes only, is general in nature, and does not take into account your personal circumstances. So just a quick refresher, if you're new to covered calls, it involves owning 100 shares of the stock or buying 100 shares and selling a call option against those shares. You earn income from the option premium, and your upside is capped at the strike price. So here's a quick look at a pretty standard Apple covered call. We've got 100 shares of the underlying, and we've sold a 1.5 month call option against those 100 shares, and that's up at about a 28 delta. So you can see that there, 245, that's where our upside is capped. From there, we don't get any more upside appreciation in the stock, but we're generating about $285, $290 in option premium against that position. So pretty standard payoff graph that you'll see pretty consistently. Short-term covered calls are going to generate higher annualized returns because you're collecting small premiums more frequently. So you can trade multiple weekly options over the course of a year, whereas if you're trading monthlies, you're only going to be able to do about 12. If you're trading 90 days, you might only be able to do 3 or 4 a year. So let's go and look at an example using Apple. So here we are again, we've got our Apple position, but this time we're using a more or less weekly option, trying to keep that around the 30 delta again. We didn't have an exactly 30 delta, but 33 delta. You can see here we've got upside potential of about $800. We're generating about $215 in premium, and that is our payoff graph. I also always like to look at a little calculator that I have in Excel, and I like to run the numbers. So all we need to do is update the expiration date, the stock price, and the strike price, and the option premium finally. So we can see here we're generating, this is our income piece if the stock stays flat and all we're looking at is the option premium. We're getting about just under a 1% return in about 11 days. So that equals about 31% annualized. Now we've got some upside potential as well between a stock price that we're buying for at 231.78, and if the stock goes up to 237.50, we've got some capital gains on our stock. If that happens, we're getting a 3.43% return, and that is about 113% annualized. So massive return on an annualized basis for trading this 30 delta weekly covered call. And again, even if the stock stays flat, we're still generating a 31% return annualized. Obviously, we've got downside risk. If Apple drops, to 215, we're going to lose a fair bit of money. So we've got to keep that in mind as well. But at the moment, we're just looking at the return from the option premium. Some of the benefits of short-term covered calls is they have really fast time decay. That last week of an option's life is when the fastest time decay occurs. You've got pretty good flexibility, so you can adjust it often. You can roll out to the next week. There's lots of different things you can do. You've got more opportunities to react to the price action, but there are some downsides as well. So they require pretty constant monitoring. If you're trading those weeklies, you have to be looking at them every day and deciding, do I need to take any action here? Whereas if we compare that to a monthly or a 3-month call option, they don't really need to be looked at every day. So constant monitoring, high commissions. If you're trading in and out every week, if you're rolling every week or every few days, you're going to be generating a lot more trading commissions. You've got much higher assignment risk as well, so there's much more chance that your stock could get called away because that time decay will be very minimal as we get close to expiration. If the stock price goes up through the strike and it's in the money, that call option's in the money, you've got very high assignment risk. You could have your shares called away. That could trigger capital gains tax as well. So in summary, short-term covered calls are great for active traders who we want to generate the most amount of premium. So we're getting the highest annualized return, but we are going to have to be very active. We need to have a lot of time. So for me, that's the biggest factor. How much time do I have to monitor and manage these positions? On the flip side, longer term covered calls generate less premium or less annualized return, but they require far less active management. So let's take a look at an example. So let's go back to our Apple example. We're using here the October 17 expiry. That's about 42 DTE at the time of recording this. And you can see we've got higher income potential overall. We've got now profit potential of about $1,600. We're generating a bit more option premium, 280 to 85 in option premium as well, but it's taking us longer to get that premium. If we run that through our calculator, let's see if we can compare these side by side. I'll do the new expiration date here, 46 DTE. Stock price, our strike price. I've tried to keep it fairly similar with the delta. And here we're going to say 285 in option premium. So you can see, even though we've got higher upside potential, we've got a strike price up at 245. If the stock goes up through the strike price and gets called away, our annualized return is actually lower because it's taking 46 DTE. So our time decay is lower. Therefore, our overall annualized return is lower. Same for the option premium that we're generating. If we just talk about the premium, we're only getting about a 10% annualized return now for the similar delta, but because we're going further out in time, we're getting a much lower annualized return. I'm not really saying this one's the best because it's got the highest return, and this one's worse because it's got the lower return. Yes, the return is better, but you've got to factor in how active you can be and how active you want to be with these trades. That's the biggest factor for me, rather than the annualized return. And you can see here at the bottom of the spreadsheet, again, if the stock goes up through the strike price, our total gain about 1604, whereas with the lower strike price, shorter DTE, our total return potential is only $787. But because it's in such a short amount of time, the annualized return is higher. But the dollar value or potential dollar return is much higher on the longer term trade. Let's look at one final example to illustrate the point, and we're going to go even further out in time. Over 100 DTE, we're going to look at the December 250 call option. Again, trying to keep it around that 30 delta. And you can see here we've got dollar return potential if it goes up through the short strike of 250. Return potential of about 2,350, 2,400. And we're generating more premium, again, $575 in premium in this case. So that means our break even's a little bit lower as well. Let's run the numbers through our calculator. And again, we're getting a pretty low annualized return, much lower than our weekly or week and a half trade. We go down, we're getting a higher potential gain if the stock goes up through that short strike around that same delta, so similar probability. But again, because it's taking 109 days, our overall return is lower. Again, I'm not saying this is a bad trade. It's going to be a very low risk, low maintenance trade, pretty easy to monitor. You might only have to check it once a week. Whereas with this one, if you want to get that really high return, you're going to have to be pretty active. You're going to have to be checking that every day. Potentially every few days, you're going to have to be rolling that position. So it really depends on how active you want to be and what sort of annualized return you want to target. Some of the benefits of long-term covered calls, much less maintenance, as we've talked about, great for time-poor traders. If you've got a really busy, stressful, full-time job, you've got family commitments, this could be a good option for you. And this is part of the reason why I like it. Based in Australia, it's very difficult to trade with the time zone. I don't want to be trading every day. I don't want to be monitoring positions every day. I want to put on these sort of 100-day covered calls, and I can leave them for a week or two and not much is going to happen. So very, very low maintenance. Less slippage because there's fewer trades and also less commission. And you've got lower assignment risk. You can see with that last example, our short strike was all the way up at 250. Apple would have to have a pretty significant rally for that short call option to go in the money and have assignment risk. Even if it does go in the money early in the trade, because it's so long to expiration, there's going to be plenty of time premium in that option. And when there's a lot of time premium in a call option, even if it's in the money, it's very unlikely to be assigned. So I know there's really low assignment risk with those long-term covered calls, much less at risk of getting my shares called away and triggering capital gains tax as well, which I don't want to do. Some of the downsides of long-term covered calls, obviously lower annualized returns is the big one. And you have much slower theta decay. So you might watch these positions and over the course of a week, you're not going to see much P&L potentially. You're not going to see much profit or loss from the theta. Third downside is they can be a little bit harder to roll. They're a little bit less liquid, longer term options, so harder to get in and out of trades, and a little bit less flexibility, much harder to roll out in time because you're already out 100 days. For example, it's much harder to then roll out and generate some extra credit. So that's one thing to consider as well. But if you don't want to watch the market daily, long dated covered calls can certainly make a lot of sense. So which style of covered call should you choose? Use short-term covered calls if you want to actively manage trade. So if that's something that appeals to you, you want to be really active in the market, definitely go with the short-term covered calls. You're going to get the highest return. Number two, you want to make sure you have time to monitor the market and you want to maximize theta decay. So that's the three factors that you should consider if you're going to trade short-term covered calls. The other point I'll mention here about short-term covered calls is they do give a little bit less protection if the stock has a big drop because you're generating less premium. When we're looking at those examples, I think it was about $200 for the short-term call. We're only getting $2 worth of protection on the stock price drop. Whereas with that longer-term covered call, we were generating about $580. Getting a little bit of extra premium does help cushion the blow in the event that the stock does drop a little bit. So use long-term covered calls if you prefer set and forget type trades. If you have limited time to manage your trades, or if you're like me in a different time zone and you don't want to be up all night trading, and if you don't mind slightly lower returns in exchange for less hassle. Don't forget, you can also have a mix of short-term and long-term trades. There's nothing that says you have to do all long-term or you have to do all short-term. It can be a good idea to mix things up a little bit. So, final thoughts. Covered calls are a great way to generate income from your portfolio, but the right time frame depends on your goals, your schedule, and your trading style. Thanks for watching. Let me know if you prefer short-term or long-term covered calls. If you found the video helpful, don't forget to like, subscribe, and share your thoughts in the comments. Reach out anytime with questions, and have a great day.